welcome to the Mutual Fund Show. My name is Neeraj Shah, and as the Indian women's hockey team is battling it out with the Argentinian team, we are out here to try and give you the best mutual fund advice. And of course, joining us on the show today is Mr. Vetri Subrmaniam of UTIMC. Needs no introduction. Really, Vetri, great having you. Thanks for joining in.
And yeah, hi Neeraj, great to be here. Thank you so much for having me.
No, the pleasure is ours. And of course, a bit later on the show, we'll also get in Amol Joshi of Plan Rupee, again a regular on the show. So again, needs no introduction. Amol, thanks for tuning in. Thanks for
always a pleasure, Neeraj. Thanks for having me.
Thank you so much. So Vetri, this is how we'll do the show. We'll have the first 15 minutes with you when we talk about your views on how do you see the landscape for mutual fund investors currently. A few other questions around the thematics and the different market capitalizations. And then, as I understand, you guys have an NFO on or will be having an NFO soon. So would love to understand the rationale for the timing as well. And then, of course, after we thank you, we'll get in Amol Joshi's views on the NFO, on the space, and some of the other things.
Sure.
Okay, so let's start with the broader climate. The index investors have nothing to complain about. We are trading at new highs. Does this make you reasonably confident about the prospects, or do you believe is there a valuation scare out there which might hamper the near-term prospects?
Yeah, sure. So, Neeraj, I think just to put things in perspective, and we perhaps discussed this in the past as well, to my mind, really from an investor point of view, when you think about it, it's all about getting your asset allocation discipline in place. And really that asset allocation discipline calls for sort of, rebalancing portfolios in favor of equities when valuations are weak, and maybe away from equities when valuations are slightly more expensive. A second derivative of that argument is to look at what the alternate asset class is in terms of its attractiveness, to consider whether that shift, if at all, rebalancing of the portfolio makes sense. So when you look at it from that perspective, let's be very, very explicit, Neeraj. The bargain basement opportunity in terms of valuations, as we now know in hindsight, unfortunately, because of the worst point of those news flow is when you got the cheap valuations, that was a great time to be taking up your allocations. To look at the rear view mirror and the last 1 year's return and now take up your asset allocations would actually not only be futile, it would be dangerous. So my only recommendation to people would be to stick to that asset allocation discipline. The fact that equities have done well in the last 1 year, which now therefore makes equities look like a fantastic asset class over the last 3 or 5 years, should not be the reason for you to raise your equity allocation. If your goals require you to raise it, then you have a reason, but not performance.
So Vetri, as I understand, while you had equities per se, and please correct me if I'm wrong, of course, but while you had equities out there at UTI, maybe your larger bent would be towards equities, but I would urge you to tell us what to your mind is the right asset allocation for an investor who's a long-term investor wanting to park money into mutual funds. How much would you believe currently at the current juncture? And maybe it could change, or maybe there should be a constant for life, but still just trying to understand what is at the current juncture, what's the asset allocation mix that you propose, so to say?
Sure. That's a very fair question for you to ask me, but let me also say it's a most inappropriate question, because I think the harsh reality of this is that we can't dispense this wisdom without knowing anything about the needs of that investor, the financial goals, the income, the spending plans, the saving capability. And it's only after all of that is known can you give a framework. Now, there are many thumb rules, invest more when equities when you're young, invest less when you're old. Honestly, the more and more I see, there are more people living into their 70s and 80s, which means actually that whole framework needs to change. Then there's a rule of 100 or 110. I find that also inappropriate. So I'm actually going to say, let's not make it so simple for people. I think there is a need for people. There are planners like Amol on this show. I think you need to sit with them. You don't ask a doctor, give me a prescription, right? You go through a whole series of medical tests and then he gives you a prescription. And that prescription is appropriate for you. It's not appropriate for somebody else. As we've discovered during COVID, using medication because somebody else used it actually does harm to your body. So I don't want to give a one-size-fits-all answer to an important question like this. I think it's something people need to work through with an advisor.
Okay, can I ask you though that because so many people are, and because there's a bunch of first-time investors, not just in direct stocks, but also in funds, because I see a lot of people actually doing both. They have a direct equity trading stroke investing account, but they are parking enough money through the funds route as well. What are the kind of risks for somebody who's looking at investing in mid-cap and small-cap funds? Because those seem to have taken the fancy, and in light of the fact that the last couple of quarters at least, mid caps and small caps have really outperformed. So people taking exposure to those funds, what are the risks that they are facing to your mind?
So two ways of looking at this, Neeraj. One is, where are we in terms of valuations when we look at large cap, mid cap, small cap? Is any one of these segments of the market showing a valuation comfort compared to the others? Unfortunately, the simple answer is that all three are looking equally expensive at this point of time. So I'm really not able to see the differential anymore. The second thing to keep in mind, and this is also important, is when I look at the rolling return differentials between, let's just take large caps and mid caps, the historical rolling return gap between these two is more like 200 to 250 basis points over a very long term time frame. Right, 5-year rolling period, 7-year, 10-year rolling periods. Now, when you go through a period of a year and a half, when the outperformance starts to become 30% and 40%, people start to think that is the norm every year. Not going to happen, right? The same feeling that people had all the way back in 2017-18, and then you paid a price for that over the next 2 years. So I would say, don't go by the outperformance of the last 3 quarters or 4 quarters. Go by the historical return differential. That's maybe 200 basis point at an index level. Finally, when it comes to small caps, and we made this point strongly last December, actually the asset class return is irrelevant. That is one category in which risk-adjusted returns are actually adverse. It's the ability of the fund manager to pick the stocks and add value to you that creates value for you in a small cap strategy. So I think, really top-down perspective, I don't see a valuation gap between any of these. The historical return gap is only 200 basis points over a longer time frame. I don't refer to 1 year, 2 year periods. And in small caps, it's the stock picking which is important. Investors want to do individual stock picking. Neeraj, I welcome investors coming into the stock market, whether they come in directly or through the mutual fund route. I think eventually it's a great thing. Everybody needs to plan for their financial future. Equally importantly, let Indians participate in the wealth creation that's happening in India. Right? Otherwise, for the longest time, we had only foreigners participating in wealth creation and providing capital. So I think it's a good thing. What many people will discover over time, that even if they can develop the IQ for investing, I keep telling everybody this, the hardest part in investing is the EQ component, right? The ability to absorb drawdowns, setbacks, to hold your conviction during difficult times. That is what eventually will create returns. If you don't have that, or you believe you don't have the process and the time to devote to that, then it's better you give it to a professional manager.
Fair call. Makes sense. Couple of other questions before we come to an NFO from your stable as well. But a lot of, how do I say, a lot of conversation around, while, as it happens every time the market moves up, towards themes that are doing really well. And fortunately, at the current juncture, there are thematic funds available which are catering to themes which don't necessarily only have a 12-month cycle to run. So my question to you is whether BFSI, because of this whole pickup in lending because of the manufacturing renaissance that India might see, or IT funds because of this whole global thematic theme that they cater to, or pharmaceuticals because of the excessive focus, or maybe the right excessive focus on healthcare. I'm trying to wonder if you advocate thematic funds at all for investors, or whether first time or otherwise, or are they specific for high risk investors?
So I won't use the term high risk. To be very honest, we do offer our own share of sector and thematic funds. But I do believe there is a big difference between these and the traditional diversified funds. They could be segmented across market caps in different ways based on regulations, but that's a separate point. in these diversified funds, what you can hope for over a period of time is the ability to capture the returns of the asset class and some alpha on top of that as well. With the sector funds and thematic funds, it's not so simple. The cycles are far more pronounced. It's not only important when you get in, it's equally important when you get out. And when you get into this loop of when will you get in and when will you get out, I find that there are too many people who manage to even sometimes get the entry point right, but they don't know when to get out. So really you need the armory both to determine entry and exit. You can improve the aggregate returns of your portfolio if you have the skill set to capture that entry and exit points. But if you don't have the armory or the skill set, then be careful, because you might realize that you're the one who actually is completely unprepared to deal with that level of volatility. So you can use it up as a return enhancer, but do you have the skill set is what you need to ask yourself.
Fair call. My final question, Vetri, on the generic side, and which is while you hit equities, a question on the debt side as well, fixed income side as well. And the common advice or the common conversation right now is that park yourself in debt funds in a way which enable you to either lower the risk or maximize returns because interest rates are going to move up. And my question to you is it as predictable, and should investors position themselves that way or wait for events to happen before they take a call like that? Because at least my experience shows it's virtually impossible to predict which way the turn of the events would be in a given year.
Sure. So, I think it again comes back to understanding what's the purpose of those fixed income funds in your portfolio. Is it to give stability to your portfolio? Is it to ensure that that part of your capital does not experience a drawdown? Right? If that's the thought process with which you're coming, then clearly you don't want to take a very big risk either on, particularly on credit, and then at a second level in terms of the interest rate risk. I'm a little bit more sympathetic, Neeraj, to the argument that I think a lot of what we are seeing in the inflation data globally as well as in India is slightly transient. The harsh reality of the fact is that the economy is running at a level of income generation which is unchanged from 2 years ago, right? The economy is underutilized. In economic terms, there's a positive output gap, which means we are operating below capacity. So to my mind, some of these inflation fears are transient unless we get a unbelievable recovery in growth, which I think the jury is still out on that. My sense is you'll see a lot more stability in rates than perhaps the markets are nervous about. I think India's case compared to, the same fear of inflation has been there in the US, and we've seen the 10-year bond in the US has actually seen a dramatic rally, right? Yields have gone down, the bond prices are up. It's not happened in India, partly because our bond borrowing program is a lot more aggressive. There are some concerns about the size of the overall deficit. And we are not the world's reserve currency the way the dollar is, simple reality. But I'm not as concerned about that, interest rate movement perhaps as some others are. I think on the credit side, why take that risk if the purpose of fixed income in your portfolio is to conserve and keep capital available for a rainy day?
Okay, so in light of all of this opinion that you have, Vetri, tell us about the new fund offering from your stable, the rationale for launching that offering, and the timing of the same.
Great. So first off, let me get to the timing aspect because that's the question I get asked most often. There's no rocket science to the timing, Neeraj. Let me be explicit. I'm not suggesting that there's something unique that I have divined about the markets today which make the focused fund the most appropriate strategy to launch in today's market and a must-own for every investor in his portfolio. That's not where I'm coming from. Look, I represent UTI Mutual Fund, right? We have schemes which have been in existence for 30 years and 35 years. Investors bought those schemes 35 years ago, they bought it 10 years ago, they bought it 20 years ago, and they've done well for themselves. I hope, and I am of the firm belief, there is a place for UTI focused investor fund, the focused equity fund in an investor's portfolio over the next 20 or 30 years as well. Doesn't matter when we launch it. And I'm explicitly telling investors, you don't have to give us money only in the NFO. If you have some money to give us in the NFO, give us a little bit there, but do a SIP, STP for the money and give us money over the next 1 to 2 years. This is not a IPO of a company where you will get it at this price in the IPO and you may never again get it at that price post listing. Of course, Neeraj, that's happening only recently. I can show you many IPOs which traded, below IPO price in the past. But this is a mutual fund NFO. I mean, you can buy it any time. The discipline is in buying it all time. So there was absolutely nothing to do with timing as regards this product. We just think we've demonstrated the strength of the investment process and the research framework at UTI across a range of strategies. Many investors wanted this kind of portfolio offering from us. We've got the right fund manager for it today, and we just felt comfortable going out there and putting the product in the market. So it's nothing to do with timing the market. And I repeat, Neeraj, even if you're looking at investing in this fund, I'll be happy to accept your check in the NFO, but I'll be happier if you split your investment between the NFO and the next 1 year or 2 years, rather than give me all the money in the NFO. This is certainly not an IPO where you will expect it to open at a premium.
Mm. And no, Sudhanshu is a good mind. I presume he's the one who is managing the fund.
Yeah, absolutely right. Sudhanshu was somebody we specifically sort of went to look for outside talent. We wanted somebody who was already comfortable with the idea of a concentrated, conviction-led portfolio. We're very glad to have him on board. He's got top-notch experience with some of the top mutual funds. He's also run a similar strategy on the PMS side. So we found him very well suited to do this with our team. We spent 4 months getting him to understand the research framework, creating the model portfolio, understanding how he would run it, and only then we've brought it to the market.
Okay. One last question, Vetri, before we let you go. And that is, will this scheme be different than the others, or do the guidelines make it difficult to have a different scheme, so to say, than the rest of the peer pack?
So good question, Neeraj. Look, internally what we do is we always look at portfolio overlaps between our individual schemes. And, this scheme has about a 30% overlap with most of our other sort of, main schemes. So it's not going to be significantly similar in terms of portfolio to the others. Partly, it's also just got to do with the concentrated 30-stock portfolio.
Vetri, sorry, I meant different from the others in the market who are also offering a focused equity fund, so to say.
There's one simple difference. It has the name UTI on it. It has UTI's core alpha investment process backing it. And it has, I think, a first-notch investment team, the fund managers and the analysts sitting behind it. That's all that is different about it. I'm not going to claim it's a rose which smells different compared to any other rose.
Okay, fair call. That's a very candid interaction today, Vetri. Thank you so much for that. We wish you all the best for the NFO as well, and see you more often.
Sure. Thanks, Neeraj.
Thank you, Vetri. Well, viewers, so that's the view from the head of equity at UTI-AMC, talking about his view on markets, specific themes, etc., and the NFO as well. Speaking of which, he advised that investors should go to experts like Amol Joshi to take care of their financial needs. And, frankly, that advice couldn't be any more sane. But Amol, I'm going to ask you a difficult question first. Welcome on the show again. I'm going to ask you a difficult question first. An NFO, the fund manager would believe that his offering is great. Thankfully, Vetri didn't say that put all the money in the NFO. But my question to you is, there are multiple focused equity funds existing in the market. Have you been able to study the UTI-AMC NFO, which is the focused equity fund? And do you recommend that? Or would you believe that investors can give that a skip and look at some other focused equity funds, if indeed focused equity funds are good to invest in?
All right. So Vetri has really made my job easier. He has very candidly mentioned that there is nothing unique. Of course, they have their core alpha unique kind of investment process backing up, and very capable team of Vetri and the fund managers who are going to manage the scheme. But having said that, in NFOs, it doesn't ever harm to repeat the traditional wisdom. And that wisdom is, do not invest into an NFO unless it brings something new to the table. So what is new? Unless it brings new geography to the table. In the sense, if there was one point in time, there was a Japan equity fund that was launched. If you wanted to participate in Japanese equities, probably that NFO was probably a good bet. But focused fund, as you rightly said, there are several other schemes already existing in the market. The second point, of course, is the existing schemes have demonstrated track record over a period of time. how the fund manager was able to handle during the sectoral rotation times, how the fund manager was able to handle during the various valuation phases of the market. If a scheme or a couple of schemes that have proven themselves in the market, I think those are probably a better bet. If you are a big fan of vetri's fund management and UTI, you can of course apply. But having said that, since it's the NFO, you are better off investing or looking at schemes with a proven track record.
Yeah. So Amol, if somebody is inclined to invest in a focused equity category, so to say, which are the funds that are good to invest in?
Right. So there are a couple of focused equity funds that you can consider. One of them is Motilal Oswal Focus 25 Fund. Second one is ICICI Prudential Focused Equity Fund. Now, both of these funds, obviously, the category name itself says that these funds typically have around 20 to 25 stocks. The first one, Motilal Oswal, that fund has taken a big sectoral bet on banking and financial services. Top 10 stocks in the fund contribute about 72% of the weight. So really, if there ever was a definition of conviction bets, I think this is what they have demonstrated. And when the financial space was not really doing well until a few weeks back or for last couple of months, we have seen a big uptick in last 2 days. Keeping that aside, I think they have been able to accumulate about 40-45% of financial services over there. And as the sector picks up again, which we saw since last few sessions, I think that scheme should do well. The scheme, since I mentioned track record, let me also mention, this scheme has about 7 to 8 years of track record and done really well over a 1 year, 3 year, 5 year parameters. The second scheme, ICICI Prudential Focused Equity, I think, see, whenever somebody talks of focused fund, even in my talk, I mentioned about the conviction bets. You would actually probably want to look at a fund manager, basically a quality or a growth bias. But ICICI Prudential Focused Fund also has a value orientation to it, typically in the style, the way ICICI Prudential manages it. And since it's a value oriented, currently they are bullish on few macro themes. Those are credit uptick in the banking sector, that's one. Real estate, that's two, and domestic recovery, that's three. So these are some of the sectoral calls, macro calls. On the value side, ICICI Focused Equity Fund takes, for which I think that's my second pick in the space.
Amol, you comfortable with the returns of say a Motilal Oswal Focus 25 or the ICICI Focus scheme?
Well, okay. So when you talk about returns, I mentioned macro calls and sectoral calls in both of the places. If you are talking about the Motilal Oswal scheme, I think this scheme has done comfortably well. About, I think, a 5-year return of 12% CAGR, a 50% CAGR return over a 3-year period. I don't think there is anything to complain. And another point, which again I touched upon in the previous bit, is that they are heavily invested, the scheme is heavily invested, about 40% plus in financial space. And that space has not been doing well for last several weeks, maybe a couple of months. Now it has really picked up. And as these sectoral themes of the fund manager play out, I think if there is any bit of complaint on returns front, I think that should get addressed as the banking and financial sector picks up from here on.
Okay. Amol, may I ask you,
yes.
So you've been on the show a few times and we've spoken about some good equity offerings from your end, the funds that people should invest into. And by the way, standard disclaimer, one size may not fit all. But Amol, if I could ask you, what is a good debt scheme to look at the current juncture and why would you recommend that?
Right. So this question I get asked a lot from investors as well, Neeraj. Thank you. I think this is going to benefit a lot of viewers and listeners. Not too long ago, maybe in last quarter, we suddenly, all of us got kind of a shock, if I can use that word, when on the government saving products, the rates were reduced. That notification, of course, was pulled back. And there is no rate reduction, so to speak. But people are really looking at some kind of increased yield or slightly higher yield compared to what bank fixed deposits are able to offer you. Now, largest banks in India are offering you a 1-year fixed deposit rate of something like a 4.9% or thereabouts, give or take. I'm considering long-term orientation and higher yield. I am looking at something called as Nippon India Dynamic Bond Fund. The scheme is dynamic space, but currently they are running a roll down strategy. Roll down strategy we have discussed several times in the past on this very show. Roll down is simply when a fund manager buys a particular maturity paper. Let's say over here the fund manager has bought 10-year paper around 1 to 2 years back, and that's why the scheme has residual maturity about 8 to 9 years. If you have a 5 years upwards or 7 to 8 years kind of investment horizon, this scheme has a very high quality portfolio, 100% into state government securities, also known as STLs. And the YTMs are very decent, I would say 6.70 in the last declared fact sheet. Because of the reasons of roll down structure, Neeraj also mentioned while speaking to Vetri about the interest rates and how they will move. When you invest into a roll down structure, and since this is typically a 8-year, 9-year product, there will be some volatility. But if you stay put for the duration, then the paper is continuously losing maturity. In the sense, 1 year later, a 8-year paper will become a 7-year paper, so on and so forth. So all the volatility that you will see in the portfolio over the next few years, if you stay put for a 5, 6 year, 6, 7 year period, I think that volatility will not affect you. So you'll benefit from the highest quality debt portfolio, number one, high YTM2, and shielding you from the interest rate volatility, especially if interest rates make a U-turn upwards.
Got it. So enough checks and balances in place, so to say. Amol, thank you for that, and thank you for being candid about the focus equity fund category as well. Appreciate you being so upfront about it. Thank you so much for joining us today.
My pleasure. Thank you, Neeraj, for having me.
Yep, the pleasure is ours, and viewers, thanks for tuning into this leg of the Mutual Fund Show.